This has certainly emerged to be my favorite event of the year, but I tell you, the Shiner Box and mimosas and Bloody Marys at 8:30 in the morning that the Surge event has is gaining a bit of ground. Participating in this event has paid dividends for Altira. We just closed on infrastructure networks literally yesterday. We met last year at this very event. A company that's bringing 4G communications to the hottest oil plays, the Eagle Ford, Bakken, Permian, etc. And it was something that was certainly analogous for us, given that we were investors in RigNet very successfully. And upon conducting due diligence, we realized that as you sort of look for that, that industry pain point that they solved, they were literally addressing something closer to a veritable trail of tears for the industry. And it's not often that a company hits its commercial stride in between term sheet and close as they did. So it's a company we're very excited about, and I look forward to working with Stan, Corey, and team to continue that momentum. What I was asked to talk about today was around building successful energy companies. Now, this is a very tough industry to do so. Certainly rampant risk aversion. You have very entrenched, tough competitors, and historically it's been very tough to correlate technology leadership with any type of financial performance or shareholder value creation. So rather than stand up here and talk to you about venture capital, what we are, how to work with us, we'd like to dive a little bit deeper and sort of frame how we see the life cycle and share some of our observations from building an energy company. And that's what I want to talk to you about today, which we call Building Energy, a Startup's Guide. Just very briefly about us, we're a traditional venture capital firm founded in 1996, focused primarily on oil and gas technology and what we call advantage service companies. Stage-wise, we target companies that are in this nebulously defined zone called market entry, which typically means they have a PO in hand at least. We're a team of 6 investment professionals, and we are based in Denver, Colorado. Now, we're an industry that's fairly renowned for a lot of platitudes. We have them. This is our slide. Things like, we like seasoned teams with energy leadership experience, a compelling technology that's unique and difficult to replicate. We like big markets that can sustain high margins and have ample opportunities for exit. But you as the entrepreneur sitting there, this doesn't add a whole lot of value. Most entrepreneurs are very confident in their management ability, their technology, and their market. So what we'd like to do is disaggregate that a little bit and walk through that life cycle in a bit of a framework, if you will, that we can share some of our observations and lessons learned across that. But first, let's look a little bit at the industry context in which you're trying to build a company. And I know some of you have probably seen this slide. This is from a 2001 McKinsey study that looked at the duration of how long does it take for a technology to achieve a material market penetration, beginning with the ideation phase. Now that horizontal axis is years. So for oil and gas, historically it's taken 30 years, just glacial, a literal multiple of other industries. And if we dig into that study a little bit, what we have on the left are some of the key findings, is that there's historically been this unclear relationship between tech performance or tech leadership and performance. Now, there have been exceptions to this rule. Statoil, for instance, has always been able to demonstrate that. But at the corporate level, it's still largely true. There are some emerging studies, however, that are getting down to another level of detail, actually looking at particular business units where they're starting to find some very strong correlations. Funding, been a problem historically, but that too is changing. Most of the companies, the integrated oil companies, the national oil companies, and the service providers have taken R&D very seriously. And if you actually look at the trends, even through the economic downturn of 08 and 09, it stayed pretty consistent. And then there are folks like us, our venture brothers, Energy Ventures, Rockport, EPIV, and the rest of us. So there's new sources of funding that can enable technology development. Risk aversion, still very rampant in this industry, although we're seeing certain players start to break the mold. The independents, the Devons, the Chesapeakes, the Williams of the world, who are much more willing to ask for forgiveness rather than permission, and they're changing paradigms. The service companies, still very much the 800-pound gorillas of technology in this space. They will resist things. They fear cannibalization of their very large business units. But they too are starting to change and implementing new programs for engaging and licensing technologies of emerging companies. But still, as an entrepreneur, a group of companies that you have to think very strategically about as you go to market. Sort of on that thread of adoption accelerating and who's doing that early adopting, this is actually a Halliburton data set, where on the vertical axis, what we have here is the percent of total spend of a customer the percent of spend that is focused on what Halliburton deems as new technology as a percent of total account value. Now the bars going across the horizontal axis are customers. The red are the independents, the Devons, Chesapeakes of the world. The black are the oil majors, and the yellow are the national oil companies. So this data set clearly illustrates who is doing the early adopting these days. So if I just pause for a second and think about the takeaways of where we stand as an industry. One is, for sure, the technology intensity of this business is increasing. Whether you're looking at unconventional plays, you're a power gen company or a clean tech company. Across the board, it is becoming the critical issue for the industry. Adoption is slow, but we're starting to see those paradigms being broken by some aggressive players. Have to consider the OFSCs in the context of rolling out anything new to this industry, and options for funding are increasing. So as an entrepreneur, how do you build a business across this landscape? Well, this is what I'd like to walk through today, a bit of how we see the life cycle, a framework, if you will. And it is with great humility that I present this. This is not Altira's 10-step program to startup success, but more of a way to share some lessons learned that for you as the entrepreneur, if you can take anything away from this that helps you sort of cut through the fog of uncertainty that you deal with day in and day out as you build your business. Structuring this a little bit more, we see this as sort of four main phases. Development, which is R&D through securing your intellectual property. Business building, assembling your team and getting the fundamental structure and how you're going to make decisions in place. The capital raise, the fun part, the part everyone wants to talk about. Then ultimately growth, going to market, the ever critical scaling phase, and finally monetization. And what I want to do is to sort of sprinkle across this framework some observations we've made for energy companies and in particular oil and gas. The first phase, development, not going to spend a lot of time here, particularly in R&D. Folks like us have typically moved downstream away from R&D, and it's largely now the domain of academia or corporate spinouts, increasing role of angels being played here. Product development, typically in oil and gas entrepreneurs are great technologists, so it's usually not an issue. However, getting things adopted, selling anything new into this business is very tough. So it's at this stage where entrepreneurs should start thinking about engaging with industry partners. Then lastly, intellectual property. As an investor, we like patents. We like to see a thoughtful IP strategy. We like to understand your exposures, your defenses, and your gaps. We like to see you work with some decent patent counsel, as they will play a very key role in making sure that you're secure for the long haul. I want to set up this slide a little bit first and give full credit to our venture brother, EPIV, for commissioning a very insightful study by the Cambridge Center for Entrepreneurial Studies. And what they did was to look at 300 companies and compare oil and gas to other high-tech sectors. And they did two things. They looked literally at sort of the fundamental DNA of the entrepreneur, and they also looked at the market. And this was the findings. First, which fits with my experience, is that oil and gas entrepreneurs are typically aces of execution. But a consistent weakness was around the commercial skill set, sales, business development, typically failing to understand customers' needs and work with them through the development process such that final products and services are aligned with what customers want to buy. There's just a natural tendency for them to focus on the nuts and bolts of the business rather than relationships. Now, I said they also looked at markets. And what they looked at was how willing are these different high-tech markets to embrace a new entrant. Zero's not good in this case. What you're facing in oil and gas is, very, very tough competitors. Lots of risk aversion, highly concentrated service players, and lots of barriers to entry. So as the entrepreneur, when you're assembling your teams, and this is such a classic area of weakness, this is something, that sales biz dev type role that needs serious thought and consideration. Governance and structure. Certainly not a sexy part of the business, and I apologize for violating every PowerPoint 101 rule with this eye chart. But what we have here in this kind of wide column here is a set of key decisions that an entity has to make. Changing the profit motive of the company, raising capital, hiring and firing senior executives. And then what we have going across the right is first, who's the decision-making body? Shareholders, board, management. And then lastly, what type of majority do you need? Supermajority, straight majority, unanimous decision? But as boring as this is, this truly sets in place the fundamental protocol for how you're going to make decisions and establishes an effective organization. The capital raise. This is the part everybody likes to talk about. This is fun. To build a good business, you need funding. To raise funding, you have to be able to effectively tell your story, your business plan, your pitch deck, etc. I see a lot of business plans. This was one that I really liked and just shamelessly stole the table of contents and pasted it in here. A couple key observations about our industry here is, first, just conceptually, do you really have an innovative solution that's solving a true market failure? That's just the starting point. Where it starts to get complicated and hard in our business is the value proposition. Typically in energy, and particularly in oil and gas, technologies are part of an integrated solution. So trying to isolate and quantify your value is really tough. Lastly, the only other thing I'd like to mention here is, given how tough it is to get adoption in this industry, also think thoughtfully around who else can you work with, what strategic partners can you join forces with that will help you succeed with your business plan. Funding. So you've written your business plan, you've done your venture capital tour de force, you get your first term sheet. There's often a bit of shock and awe. You want what? And the purpose of this very busy slide is to really illustrate that there is a market for terms. You as the entrepreneur can go to places like NVCA or Wilson Sonsini's site and do research, not to just understand what does this term mean, but also understand where the deals are trending. If we take a look at the two charts on the left, just as example, they're around liquidation preferences, which means me as the investor, I get my money back first. So the top one shows that senior liquidation preferences, which means me as the last investor in, I get my money before anybody else does, are trending down as a percentage of total deals. The one right below it is around participating or non-participating preferences. Difference between those are, in participating, you give me my money back and I still get to keep all my stock. Non-participating, you give me my money back and you tell me to go away. And so you can see that the percentage of non-participating prefs are increasing. So the combination of these two effects or trends are very positive for companies. This highlights the sort of increasing valuations of sequential rounds and the shift of negotiating power to existing investors in the company. Continuing on this thread, this is just a few time series of valuations, the percent of financing rounds that were down rounds, flat rounds, or up rounds. So the period of misery is very clear. And since then, we've been on a nice trend of up rounds. There's lots of money ready to do deals, sitting on the sidelines. So it's a great time to be raising capital. And then also specific to the exact valuations, this is just a quarter-by-quarter trend line of actual valuations, pre-money valuations. What we see in the yellow are Series A deals. This is first institutional round, not angel investors. The gray is Series B, and then the red is Series C and later. That's the real takeaway from this slide, is look at the premium that's being paid for established businesses. And it's increasing. This is a great trend for what's happening in the venture business these days. So, you've raised your funding. Let the fun begin. Now, I previously mentioned how challenged oil and gas entrepreneurs are with things like sales. This is where this really comes to roost. And this is where we end up working with our portfolio companies fairly closely, is establishing best practices across their go-to-market strategy, helping them think about segmenting the markets, figuring out where you should target and prioritize, channel strategies, who should we work with as agents to help sort of expand our sales force and get leverage. Then ultimately around just getting some just kind of blocking and tackling stuff in place, account management, helping the sales teams roll out, and how we're going to measure and track them over time. Premature scaling. The startup Genome took a look at 3,200 companies and figured out that premature scaling is the #1 cause for startup failure. This chart here at the top is really just lays out the amount of monthly revenue that a company had when they made that decision to scale. Red being successful, gray unsuccessful. The entrepreneurial sin that this is addressing is effectively mistaking early adoption for broader market acceptance as a whole. And now the actual numbers here are staggering. 70% of the 3,200 companies they looked at scaled prematurely. 74% of those companies failed. Of the companies that scaled at the right time grew 20 times faster than those that didn't. Blew me away. Now that's just not energy companies, that's sort of all sort of venture across high tech. But the main takeaway here is until that product market fit can truly be established and that pattern of revenue recognition can really be identified, don't scale. Lastly, the exit, monetization, getting a return for your investors, your founders, and employees. Now, the bottom chart is really just a sort of macro perspective of global energy M&A activity. Takeaway being that, hey, this is a big liquid market for exits, hyper acquisitive. Right now in our business in oil and gas, a little bit of downturn in commodity prices, yet service company rates are high. Both of those things have a bit of a downward pressure on M&A activity. But this is a great business to sell companies. It is just a hyper-acquisitive place. That's how the service companies built themselves. You got a very active private equity industry, and there's lots of capital sitting on the sidelines. And that really wraps up my presentation today. We do feel at Altira that we're really standing at a watershed for the industry as far as the role of technology. Building businesses in this industry is tough. There are certainly some structural disadvantages that every entrepreneur has to overcome. And that's what we're here to do. Altira is here to help fund innovative entrepreneurs and build great companies. And it's something that I do feel very fortunate that I get to do for a career. Thank you.